Hey everyone, welcome back to Corporate Decoder, the place where we help you make sense of the complex world of business reports. And when I say complex, I mean really, really complex, because today we are diving into Roadzen Incorporated's latest financial report. And let me tell you, this report is packed with enough numbers and legal jargon to make your head spin. But don't worry, I am here to untangle it all for you, and we might even find a few surprises along the way. And before we dive in, if you appreciate getting straight insights from thick corporate documents like this, make sure you hit that subscribe button and ring the bell so you don't miss any future videos. We also have a fantastic community over on Discord where we break down these filings, and more so, make sure you check out the link in the description below to join the conversation. Alright, so this is Roadzen Inc's quarterly report. It's like a checkup on the company's health for the period ending the 31st of December 2025. Now, Roadzen is an insurtech company, meaning they use technology to make insurance work better, especially for cars, and they operate globally, serving a bunch of different clients like insurance companies, car makers, and big fleets of vehicles. Let's jump straight into the numbers, the most important part of any financial report. First off, look at their total assets here. They stand at over $44 million. This is everything the company owns. Think of it as the company's total net worth at this specific moment. Now let's talk about what they owe to others. Total liabilities are over $68 million. This is what they owe to banks, suppliers, and other creditors for this period. This is important because it represents their debts and obligations. And here is where it gets interesting. Total shareholders deficit is a negative number over $26 million. This means that as of the 31st of December 2025, the company owes more than its assets are worth. If you were to sell everything the company owns, you would still owe money. This is a significant red flag and something we need to pay close attention to. Now let's look at the income statement. The story here is pretty clear. Net loss attributable to ordinary shareholders for the 3 months ending the 31st of December 2025 was a little over $9 million. That means for every dollar of revenue they brought in, they lost money. And for the 9 months ending the 31st of December 2025, the loss ballooned to over $15 million. This shows a consistent pattern of losing money over a longer period. But wait, there is a bit of good news. Revenue, the money they brought in from selling their services, actually increased. Revenue went up by about 19% for the 3 months ending the 31st of December 2025. Compared to the same time last year, this growth was fueled by consolidating a new business in China and adding clients in India. This is a positive sign that their core business is still growing despite the overall losses. However, whenever revenue goes up, so do costs. In this case, cost of services increased by about 22%. This means that it cost them more to deliver their services, and this increase is linked to that new Chinese business they brought on board. Now let's talk about how they are trying to get more customers. Sales and marketing expenses actually went down a bit by about 4% for the 3 months ending the 31st of December 2025. This might seem like good cost management, but it could also mean fewer resources are being put into attracting new customers, which might slow down future growth. On the flip side, general and administrative expenses, which cover things like salaries and office costs, went up by about 22% for the 3 months ending the 31st of December 2025. This increase is attributed to that new Chinese business and another new acquisition called Elatech. And then there is the interest expense. This is the cost of borrowing money. This shot up by a massive 194% for the 3 months ending the 31st of December 2025. This is a huge jump, and it directly contributes to their losses. It means they are borrowing a lot more money, likely to fund their operations and growth. This next part is a bit technical. Fair value changes in financial instruments carried at fair value represents the ups and downs in the value of certain investments and liabilities they hold for the 3 months. Ending the 31st of December 2025, they saw a loss of over $5 million here. This is a big swing and adds significantly to their overall loss picture. This loss is largely due to how they value things like convertible notes and warrants, which are basically promises to issue shares in the future. Even though they are reporting a net loss, Roadzen uses a measure called adjusted EBITDA to show their operational performance. This is a way to look at their earnings before certain non-cash items like interest, taxes, depreciation, and things like stock-based compensation. For the 3 months ending the 31st of December 2025, their adjusted EBITDA was a loss of about $574,000, still a loss, but not as bad as their net loss, which is good if you are trying to see the underlying operational trend. But for the 9 months, this operational loss widened considerably to over $3 million. Now let's look at cash flow, the lifeblood of any company. For the 9 months ending the 31st of December 2025, they used over $16 million in operating activities. This means more cash went out than came in from their everyday business operations. This is a significant outflow and shows the company is burning through cash to keep running. This is largely driven by the net loss and changes in their working capital, like how much they owe and how much is owed to them. Where is the money coming from? Well, for financing activities, they brought in over $6 million from issuing ordinary shares selling new pieces of the company. And they also got over $6 million from issuing equity shares of a subsidiary. This shows they are raising money through stock sales to keep the lights on. Now let's talk about some of the big risks highlighted in this report. They talk a lot about their new consolidated business in China. They are concerned about geopolitical risks, trade tensions, and potential limitations on investing in Chinese companies. They also point out that getting accurate financial information from this new venture is a challenge, and this could lead to material misstatements or even write-offs of their investment. Another big risk is that their control over this Chinese joint venture is based on board control, not majority ownership. This means if things change with Chinese regulations or their governance structure, they could lose control, which could mean a big financial hit and a negative impact on their reported numbers. So what is the overall picture here is my take on Roadzen. Incorporated, their revenue is growing, which is a definite positive, especially with the new consolidation. In China, this shows they are expanding their reach and bringing in more business. However, the company is still losing a lot of money and their shareholder deficit is negative, meaning they owe more than they own. The sharp increase in interest expense suggests they are taking on a lot of debt to fund their operations, which is a risky strategy, especially when you combine that with the significant losses from fair value changes in negative. Their financial instruments, this means the value of some of their investments and liabilities is swinging wildly, which adds to the uncertainty. The biggest concerns are the consistent net losses, the growing debt, and the significant risks associated with their new consolidated operations in China, especially the lack of guaranteed financial transparency from these overseas ventures. While their focus on AI and technology is smart and positions them for the future, the immediate financial health is a serious question mark. They are heavily reliant on raising external capital to survive, and that can be a precarious position for any company. Overall, Roadzen is in a race to grow and innovate, but they have a very long road ahead to achieve ability and financial stability. The market is clearly betting on their future growth potential, but the current numbers paint a picture of a company under significant financial pressure. Investors should watch closely how they manage their debt and improve their operational efficiency while also addressing the risks in their international operations. Alright, that is our deep dive into Roadzen Incorporated's latest report. What do you think of these numbers and what they signal for the company's future, especially with all those risks they highlighted? Let us know your thoughts in the comments below. If you found this analysis valuable, hitting that like button really helps us out. And of course, subscribe for more Decode corporate filings and business news. Thanks for watching, and we will see you in the next video.